Welcome to Highway Herald, your roadmap to the latest in auto. Today, we're diving into the tumultuous waters of the Chinese EV industry. It's no secret that they're facing a storm of slow sales, an oversupply crisis, fierce price wars, and elusive profitability. Tesla's CEO foresaw this rocky road, predicting that while Chinese EV manufacturers might eventually dominate the market alongside Tesla, they would also have to navigate a sea of challenges. His foresight seems to have hit the mark, and today we're exploring 6 reasons why his predictions about the Chinese EV industry struggles were spot on. Starting with reason number 6, the capital crunch. Rewind a few years, and the Chinese EV landscape was teeming with startups. Some reports put the count at over 500, a number that was clearly unsustainable in the long haul. The biggest hurdle these companies faced was securing a steady cash flow. Many were heavily reliant on government incentives, but even China's robust economy couldn't prop up so many players. As the bar for requirements kept rising and vehicle sales fell short, many companies found themselves without any support. This hit the smaller-scale second- and third-tier EV makers particularly hard. These manufacturers struggled to maintain a steady cash flow, leading to disruptions in their capital chains and significant operational challenges. Some managed to set up decent production lines, but their minimal profit margins meant they couldn't achieve the desired product quality and competitiveness. This led to a drastic drop in numbers, from 500 manufacturers in 2017 to around 90 today. However, even this figure is under scrutiny, with recent reports suggesting that only 20 manufacturers are currently operating at 60% or more of their production capacity. Moving on to reason number 5, the profit paradox. Musk highlighted that a business can't sustain itself with minimal or non-existent profit margins. This is a challenge for Chinese EV makers like BYD, NIO, XPeng, and Polestar. Despite their technological breakthroughs, most are yet to turn a profit. Their profit margins, if any, are significantly lower than Tesla's. BYD is reportedly the only profitable Chinese EV company, with the rest either losing money or barely staying afloat. NIO, despite its technological feats and robust production system, fell short in sales, losing around $35,000 on every vehicle sold last year. This has led them to seek new investors outside China. Polestar, once viewed as Volvo's high-end electric division, faced losses too large for Volvo to continue funding. Going forward, Geely will be the sole investor, with Volvo still contributing to new model development. This situation underscores the challenges faced by even the most promising players in the EV market. It's a stark reminder that technological innovation alone is not enough to ensure success in the competitive world of EV manufacturing. Companies must also have a solid business model and a sustainable source of capital to thrive in this industry. Reason number 4, the bankruptcy wave. Musk predicted that the saturated EV market would inevitably lead to a wave of bankruptcies. The number of EV makers has already plummeted from 500 to 90 in a few years, and this is just the start. In recent months, we've seen 5 bankruptcies, most of which were once considered promising. Take WM, for instance. Despite its impressive technology and substantial initial capital of $5.3 billion, it failed to establish a functional operational model and went bankrupt due to poor sales and supply chain issues. Even companies part of larger conglomerates weren't immune. Evergrande New Energy Auto, despite being part of a global conglomerate and having ample resources, went bankrupt due to poor sales, losing $17 million on every EV sold. Neutron and Letton are just a couple more names in the growing list of bankruptcies. This wave is far from over. Many more bankruptcies are expected in the coming months. According to Asian sources, at least 15 once promising companies are either done or on the brink. These 15 companies had a combined annual production capacity of over 10 million units. Before we delve into reason number 3, take a moment to subscribe to Highway Herald. Your support fuels our drive to bring you these insightful videos. Now let's uncover reason number 3, trade barriers. Elon Musk once stated, "Frankly, I think if there are no trade barriers established, they will pretty much demolish most other companies in the world." He was highlighting the competitiveness of Chinese EV companies and predicted that 9 out of the top 10 global car makers would soon be from China, with Tesla being the only Western competitor. However, Western governments have implemented various protectionist measures to prevent the easy expansion of Chinese companies. This has limited the number of Chinese companies, primarily legacy car makers like MG and Geely, that have managed to sell their EVs in Europe. On the other hand, EV startups and other companies are compelled to compete in the domestic market. Despite its size, the market is somewhat limited due to the number of car makers and the slow adoption of electrification by Chinese citizens. Currently, plug-in electric vehicles account for just over a third of the total automotive market. In such a competitive environment, even dominant companies like BYD face struggles, leading us to another reason why Musk's observations about the challenges in the Chinese market were spot on. Reason number 2, the BYD Dilemma. One of the most significant challenges facing Chinese companies today is their struggle to break into Western markets. Even industry leaders like BYD, despite having a presence in Australia, have minimal market penetration in Europe. As a result, a staggering 95% of their sales are confined to domestic markets. Given this, it's no surprise that the current slowdown in the Chinese EV market has significantly impacted BYD's performance. In February alone, the company sold 50,000 electric cars, marking a substantial 40% decrease compared to January. Year-over-year results indicate that this isn't just a typical February slump. Sales were down 37% compared to the same month last year. BYD has long been considered Tesla's biggest global competitor, but recent sales figures highlight the challenges it faces, particularly its over-reliance on the domestic market. Consequently, BYD was compelled to buy back some of its shares recently to protect shareholder interests and boost investor confidence. As a result, the company invested $55.6 million to double the number of A shares. What lies ahead is uncertain, but the current outlook is far from optimistic. Reason number 1, the onset of the bloodbath. Considering everything we've discussed, it's fair to say that the so-called bloodbath has already begun. The market is slowing down, and the ongoing price war is affecting everyone. The giants are faltering, while most of the smaller companies are on life support. We've already mentioned that only about 90 EV companies remain in business in China. That number is set to plummet rapidly in the future. Out of these 90 companies, at least a third produce fewer than 500 vehicles quarterly, while only 20 companies operate at 60% or more of their capacity. Furthermore, the gap between the big players and the smaller ones is widening. Currently, the top 10 companies account for at least 80% of the market. BYD alone holds 35% of all EV sales in the Chinese domestic market. So, we can agree with Li Auto's CEO that there are only two possible outcomes. One is to see all these companies filing for bankruptcy, while the other is to see these smaller companies banding together. With government assistance, we may see some of these EV makers survive. Thank you for joining us on this journey through the world of vehicles. Don't forget to subscribe to Highway Herald to stay updated on the latest vehicle updates and upcoming videos. See you next time.